Good afternoon. If you'll all find a seat, we will begin. Thank you. Welcome to the third meeting of the Audit Subcommittee, this interim. And please excuse Chair Hadagi. She'll be joining us late this morning, so we'll mark her present as she arrives. Ms. Lisa Kramer, will you please call the roll?
Assemblywoman Dickman.
Here.
Senator Dondero Loop.
Here.
Senator Hammond.
Here.
Assemblywoman Miller. Chair Howdigi.
Please mark her present as she arrives. Thank you very much. Special thanks to all of those who are participating in the meeting today. We have representatives from various state agencies and the Nevada System of Higher Education and the county child welfare agencies with us today. A couple of important housekeeping items for those individuals on Zoom. The chat feature is only to be used for communication with BPS for technical assistance. It is not to be used for any communication between members or by presenters unless you are requesting technical assistance with BPS. Before we begin, for the benefit of the audience and those wishing to speak, we will have 2 periods of public comment today, one at the beginning of the meeting and one at the end of the meeting. Public comment is limited to 3 minutes per speaker. There are 5 ways to provide public comment, and those are in person in Las Vegas or Carson City. You can call 669-900-6833, and then you enter meeting ID 884-8757-0277, followed by the pound sign. Emailing comments is also allowed to the LC Audit at lcb.state.nv.us, or you can always mail your comments to the Audit Division at 401 South Carson Street, Carson City, 89701. If you need to fax comments or scan, you can send those 775-684-6435. So thank you all for being here today, and we'll start with our first public comment. And is there anyone here in person who would like to make public comment in Las Vegas? Seeing none, I'll go to Carson City. Anyone in Carson City who would like to make public comment? Anyone? Seeing none, we'll go to the phone lines. BPS, when you're ready.
Thank you, Vice Chair Dondero Loop. To provide public comment, please press *9 now to take your place in the queue. Once again, to provide public comment, please press *9 on your phone now to take your place in the queue. Chair, the public line is open and working. However, there are no callers wishing to provide public comment at this time.
Okay, thank you very much. And we'll move to the next agenda item, which is approval of the minutes for the meeting on May 4th, 2022. Members, are there any questions, comments, or changes regarding the minutes? Seeing none, I'll take a motion to approve the minutes. So moved. Motion from Assemblywoman Brittany Miller, second. Second from Senator Hammond. Any discussion? All those in favor say aye. Aye. Aye.
Aye.
Thank you. All those opposed? Motion passes. Thank you very much. Okay, we will start with agenda item number 4. The first agenda item is from Mr. Crossman, and when you're ready, please go ahead.
Thank you, Vice Chair. For the record, Dan Crossman, Legislative Auditor. Under agenda item 4 today, you'll see we have 5 performance audit reports to present. These reports have been maintained confidential until they are being presented today. Copies of those reports will be made available on our website following the meeting. I'd like to just take a quick moment to express my appreciation to my staff, first of all, for the work they put in to complete these audits. We see the tip of the iceberg often with a short report that summarizes the work that's been done. But recognizing that there are thousands and thousands of hours and thousands of documents that sit behind that work. Additionally, we'd like to thank the agencies and for all their cooperation and the work that goes into assisting us in the audit process. And we recognize that they do make some sacrifices to help us ensure that we can get our job done as well. So with that, Vice Chair, I'll turn it back over to you to introduce the first sub-agenda item for 4.
Thank you very much, and I also appreciate you and your staff. All right, so we'll go to item number 4, which is the Nevada System of Higher Ed, Self-Supporting and Reserve Accounts. And we have got Sharon Rydell and Damian Meeks here. And I'll start with any questions from the... I'll start with the presentation first. And so if whoever is making the presentation, I see you in Carson City. Thank you.
Good
Please
morning.
go ahead when you're ready.
Good morning, Vice Chairwoman Dondero Loop and members of the Audit Subcommittee. For the record, my name is Shannon Rydell, and I'm the Chief Deputy Legislative Auditor. We'll start today with the Nevada System of Higher Education, Self-Supporting and Reserve Accounts Performance Audit. If we can start with some background information on page 1. NISHE is a state-supported land-grant institution established by the Constitution of the State of Nevada in 1864. NISHE has 8 institutions with an administrative function, 2 universities, 1 college, 4 community colleges, 1 research institute. Continuing on page 2, NISHE is governed by the Board of Regents, a 13-member elected body who is responsible for executive and administrative control. The Nevada Constitution requires the legislature to appropriate funding from the state's general fund to support NISHE activities. NISHE also receives student tuition and fees, grants and contracts, sales and services, contributions, gifts, and investment income. On page 6, we provide more detail regarding self-supporting programs and activities. NISHE institutions utilize self-supporting revenues to help pay for institution activities. Revenues consist mainly of student fees, investment income, indirect cost recoveries, and sales and service income. Student registration fees are allocated between state-supported and self-supporting accounts. Student registration fees and self-supporting accounts can be used for student access or student financial assistance. General improvement fees are to be used on services that enhance the educational experience. Capital improvement fees are for buildings and infrastructure. Activities and programs fees are for student activities, and fees also support the student associations. At the end of 2022, about $629 million remained in self-supporting program accounts. Our scope and objective can be found on page 8. This audit was required by AB 416 of the 2021 legislative session. The objective was to analyze financial activity related to self-supporting accounts and reserve accounts for fiscal years 2018 to 2021. Our findings and recommendations begin on page 8. Minimal system-wide oversight and variations in internal control systems and operations at NISHE institutions contributed to inappropriate or questionable financial activity. Significant financial transactions at or near year-end moved expenditures between state-supported and self-supporting accounts to utilize all state funding. Additionally, few controls exist over these transactions, so expenditures did not always align with the appropriate category. If you turn to page 10, we have Exhibit 4. This exhibit shows total state appropriations and related expenditures for fiscal years 2018 to 2022. As you can see, less than 1% of state appropriations have been reverted over these years. This has occurred because institutions can revise approved budgets, and also initiate accounting transactions that move expenditures between accounts each fiscal year with limited board or legislative oversight. As we continue to discuss on page 11, NISHI's budget was, at one time, more detailed and subject to legislative scrutiny. But after 1991, state appropriations were provided in a lump sum allocation. A legal opinion received for our audit in 1996 discusses some of the limitations the legislature has on monitoring the activities of NISHI. Per the Nevada Constitution, management and control of system activities, including the expenditure of money appropriated, is the responsibility of the Board of Regents. At the bottom of page 11, we discuss a policy consideration for the legislature. Here we discuss that NISHI has flexibilities other agencies receiving state appropriations do not have, and that this flexibility does not necessarily equate to an approval by the legislature to utilize state funds by any available means. As such, the legislature may wish to consider whether NISHI's actions to move expenditures from self-supporting accounts to utilize all state funds first meets with legislative intent. We'll continue with our findings and recommendations starting on page 13. Here we also found some activities from self-supporting accounts bypassed state law. We discussed that $270,000 in state appropriations were not reverted when used to offset centralized services in a self-supporting account. Additionally, as noted on page 14, reallocations of about $2.4 million in general fund appropriations were not approved by the Interim Finance Committee as required by the Appropriations Act. Continuing on pages 15 and 16, we discussed that some student fees were not used appropriately. We found 2 institutions used about $6.7 million in general improvement fees for athletics and band costs. Board policy indicates these fees should be expended to enhance the educational experience of the student body. Our concerns regarding using general improvement fees for athletics and band include that funds may not be used for educational purposes and may only benefit a small number of students compared to the student body at large. Additionally, we found 1 institution used differential and technology fees for centralized administrative services. During fiscal years 2018 to 2022, nearly $1.5 million in differential and technology fees were used to pay for centralized services and institutional priorities. Board policy states these fees should directly support the high cost or volume of the program for which they are approved. The institution was able to use some student fees for questionable purposes because institutions have significant autonomy to develop and maintain internal control systems, and few system-wide controls to monitor individual institution activities exist. On pages 18 and 19, we discuss issues with reporting. Certain reports regarding student fees lacked sufficient detail to adequately monitor this issue. The board requires each institution to report the amount of student fees remaining unexpended each year. However, reports provided information for each fee overall without the detail needed to monitor individual programs or specific student fee reserves. Exhibit 5 on page 19 shows an example of the reports provided. Because reports provide general information and include other sources of funding, individual program-specific accounts may not receive adequate scrutiny. On page 21, we have 8 recommendations to establish control and oversight regarding transfers, student fees, and reporting. Our next chapter deals with reserves not being adequately managed by NISHI and begins on page 23. The use of reserve and contingency accounts varied widely among institutions. Some institutions established multiple reserve accounts and others had 1. Exhibit 6 on page 24 shows the variation in the number of accounts and activity related to reserve accounts for fiscal years 2018 to 2021. Board policy addresses 1 contingency reserve account for system administration, indicating a target of 30% of the prior year's annual income should be established for shortfalls in revenue or unbudgeted expenditures. However, board policy does not address sufficient reserve levels at institutions or provide guidance for establishing reasonable limits on balances. As we note on page 25, while most reserve accounts were funded with unrestricted revenue sources, we found about 10% of funding transactions tested for $2 million were funded from sources that included student fees. Board policies are vague on whether these student fees can be used to fund reserve accounts. Also, we found about 20% of expenditure transactions tested were for normal operating costs that included payroll, printing, computer, and office equipment. These do not align with best practices regarding reserve accounts. Continuing on pages 26 to 29, we discussed that student fees and other funds were not utilized timely. We found 44 of 189 programs with student fees retained more than 1 year of revenue for at least 3 consecutive years. On average, these programs retained about 2 times average annual revenues and amounted to about $20.7 million at the end of fiscal year 2021. Exhibit 7 on page 27 shows the programs with the highest ending balances at June 30th, 2021. Holding student fees in reserve for 2 years or more violates board policy and suggests there may be an opportunity to reduce fees. As noted earlier, board policy requires institutions to report student fees and related ending balances to the board annually. But the lack of detail in reports prevents the board from conducting a thorough review of student fees. Other self-supporting programs funded with investment income, sales and service, and other operating revenues also retained significant funds over the 4-year period. Of 999 programs reviewed, 147 carried balances that exceeded 75% of annual uses. These 147 programs retained about $179.4 million in funds at the end of fiscal year 2021. Exhibit 8 on page 29 shows the number of programs and the related cumulative average balance over our audit scope period. In certain instances, retaining a high balance in the program from 1 year to the next may be appropriate. However, little system-wide monitoring of self-supporting program balances exist, and the board has not developed policies over non-student fee self-supporting programs. We have an additional 5 recommendations on pages 29 and 30 that cover reserve and contingency accounts. Our last chapter, covering pages 31 to 35, relates to the structure, monitoring, and control practices over NISHI's investment operating fund. We found these practices were reasonable, and NISHI was able to offset most of the mandatory budget reductions related to the pandemic from reserves and gains on the investment account. Exhibit 9 on page 32 shows those budget reductions and the related investment distributions meant to offset some or all of the reductions. Additionally, Exhibit 10 on page 33 shows the various types of relief NISHI had available for use related to the pandemic. Finally, Exhibits 11 and 12 on pages 34 and 35 show each institution's average daily balance for June 2022 and the operating pool and reserve account balances at June 30th, 2018 to 2022. On pages 38 to 42 is our Appendix B, which shows each institution's self-supporting accounts financial activity for fiscal years 2018 to 2022. Appendix C on page 43 begins our methodology, and NISHI's response to our audit begins on page 48. As shown on page 50, NISHI accepted all 13 recommendations. That concludes my presentation. I'd be happy to answer any questions you might have.
Thank you so much for that information. And do I have any questions from the committee? Senator Hammond, please.
Thank you, Madam Chair. The question I have, going back to, I think it was your Exhibit 10, we were talking about the money that that NSHE used to try and supplement or try to fill the hole that COVID created. I'm not an accountant, so I don't know how this all happens, and maybe it's not you that I need to talk to, and maybe it's folks from NSHE. But there was a hole. They took money that they had put in, and I'm going to get this wrong, I know, but they have investments. They take some of the money from those investments, plug that hole, and then you have money coming in from the federal government, ARPA money and other money that comes in. Then at that point, that's where it gets murky for me. How do they fill that hole back up after that? Is it, did they cure those investments? Did they put the money back into the investments? Just kind of curious at that point what happened with the money, because it looks like they got money from the federal government to help supplement that loss. I hope I explained that well enough. I'm just confused because I'm not, I did not study this in college at all.
Vice Chairwoman Dondero Loop, through you to Senator Hammond. I don't have all of the specific details regarding how all of this money was used, but on a brief overall level, the investment income distribution was made specifically to cover the gap on the budget reductions that were required from Governor Sisolak and then through the legislature in the special session. However, the second distribution was made in August of 2021, I believe, and then right after that, in December, the Coronavirus Response and Relief Supplemental Appropriation Act kicked in. So all of the institutions didn't necessarily need to use all of that investment distribution, partly because they'd already covered some of those budget reductions because they had to be done earlier in fiscal year 2020, and partly because the 2021 reductions hadn't taken full effect yet because they were only in the beginning of that fiscal year. So some of those investment income distributions weren't needed once the federal supplemental dollars were available, and some of that money was even still sitting in certain accounts at certain institutions at the end of fiscal year 2022.
Okay, so I think I just wanted to know if they were made whole, and it sounds like they're made whole, and in some cases they didn't even use the money. Thank you.
Any additional questions? So I just have one, and that is I have concern over the use of student fees. And so as we look at recommendations that this doesn't happen, because it seems like just thinking back across many years, it seems like we kept raising student fees, but they weren't being used necessarily for direct student. We just raised student fees, I think, at UNLV for something. So I guess my question is moving forward, how are we going to spot check or make sure that that isn't done so that we don't keep raising fees on the students? And I don't know if that's a you or the chancellor.
Vice Chairwoman Dondero Loop, for the record, Shannon Rydell. That might be a better question for NISHE personnel. I don't necessarily, I mean, they have several different kinds of student fees, but I don't know what their intention is, how they intend to implement the recommendations to make sure student fees are adequate and not too high.
Thank you very much, and they are at the table. Please go ahead when you're ready, Chancellor.
Thank you, Madam Vice Chair, members of the subcommittee. For the record, I'm Dale Urquiaga. I'm the acting chancellor of the Nevada System of Higher Education. If I may, Madam Vice Chair, first I'd like to thank your staff and Mr. Crossman for his work on this. As I think the subcommittee is aware, I became chancellor in July, so this audit was underway, and the audit scope period is a time that I was not chancellor, but Mr. Klinger, who was here with me, has been with the system through this scope period. So I just want to acknowledge your staff. They've been very thorough and very helpful to me as we sort through these recommendations. Specific to the question about what will we do, you'll see in our acceptance of all the recommendations, we've already begun working on policy changes. INSHE is, as the committee is no doubt aware, really 8 agencies within an agency. And the board has, at differing times, sort of a loose, tight arrangement of delegation of authority to the institutional presidents, and that Sometimes we are tighter, sometimes we are looser. And what I see here, particular to student fees, this came up at our December meeting, and this is of, I think, primary concern to the Board of Regents, that we not overcharge students, and that if we are charging students, that we are certain that those monies are spent on the function that we said it would be spent on. So I find in this audit a good deal of advice for us to improve board policy about how student fees are allocated and spent, and board policy about what to do if there are reserves, if more monies are collected in one year, and how they might be carried into the next year. I also find recommendations here for an increased monitoring role. We are very grateful that your auditors were able to go through our books in this depth. Mr. Klinger, as the Chief Financial Officer, does not have a monitoring department. We have an internal audit department, which incidentally reports directly to the Board of Regents, does not report to me as Chancellor. But we see here some need for us to change our monitoring role on an ongoing basis so time does not lapse. After that lengthy explanation, Madam Vice Chair, the short answer to your question is we will propose policies at the board level to govern both the allocation of student fees, to be clear when how an institution ought use them, and the reserve of if balances are accrued. And if I got any of that wrong, Mr. Klinger will now correct me.
Madam Vice Chair, for the record, Andrew Klinger, Chief Financial Officer. Chancellor got everything correct. I think the only thing I would point out when it comes to student fees is that current board policy does require that student fees be, that we carry forward no more than 1 year, essentially, of student fees. Exhibit 5 in your audit, which is on my page 19, that is the report that we typically send to the board. And what your staff found, and we're appreciative of your staff, is that within that, so we roll that up at a very high level, as you can see on page, on that Exhibit 5. And so what your staff has identified is that within that, there are many programs that individually had funds in excess, but when you roll them all up, you don't see it. So part of what we need to do is provide more detailed and better reports for the board so that they can see where we do have excess student fees. Because in this report, you won't see them if they're within a single program.
I appreciate that clarification from both of you, because I think that's always an important piece when we keep, adding student fees, whether it's 20 cents or $1. Those start to add up to the cost of higher education. So thank you very much for the clarification and putting that on the record. I appreciate that. Any additional questions from the committee? Seeing none, I'll take a motion to approve the audit report. So moved. Thank you, Assemblywoman Miller. Second from Senator Hammond. Any discussion? All those in favor? All those opposed? Thank you. Motion passes. And we will move on to agenda item 4B, which is also the Nevada System of Higher Ed capital construction projects. And we'll welcome Mr. Thorne and Mr. Peterson to the table. And please go ahead when you're ready.
Thank you. Vice Chair and committee members, for the record, I am James Thorne, Deputy Legislative Auditor. Beginning on page 1 and continuing through page 5, we provide background information on the Nevada System of Higher Education, NCHE, including the agency's mission and more specifically the funding, management, and procurement of capital construction projects. This section includes 2 exhibits which highlight capital construction spending and state-approved funding. On page 6, we state our audit scope and objective. The objective of this audit was to determine if the University of Nevada, Las Vegas, UNLV, and the University of Nevada, Reno, UNR, manage capital construction projects in accordance with laws, policies, and appropriate management standards. The audit findings begin on page 7, where we note that NCHE needs to enhance its policies and procedures to ensure institutions' capital construction project funding and management practices comply with state law and NCHE policy. Specifically, UNLV and UNR used almost $5 million in state-appropriate operating funds to help pay for capital construction projects we tested. These state operating funds were not approved by the legislature for the use in capital construction. 10 of 27, or 37%, of projects tested at both institutions used state operating funds. Exhibit 3 on page 8 shows the state appropriated operating funds used and total project costs for 10 projects. Exhibit 4 on page 9 shows the use of those state appropriated funds, including construction and design services costs. On page 10, we note the practice of using state operating funds for capital construction was so these funds would not revert to the state. For example, one project showed institutional staff issued a change order to use state operating funds that otherwise should have been reverted to the state at the end of fiscal year 2019. This was done through a change order that increased the project scope to add floor insulation material at the cost of over $190,000. Through the Appropriations Act, unused state operating funds provided to NCHE must be reverted to the state. Furthermore, Board of Regent policy states that funding derived through state funds must be used to the greatest extent possible in support of student credit-based instruction. Continuing on page 11, the report discusses how state law requires NCHE projects funded with at least 25% of state appropriations use the construction management services of the State Public Works Division. In addition, NCHE policy requires all projects funded in whole or in part with state appropriations be managed by State Public Works Division. However, State Public Works did not manage the construction of 10 of 27, or 37% of projects tested that used state operating funds, including 3 projects with greater than 25% of the construction cost paid with state appropriated operating funds. On page 13, we note completed construction projects exceeded funding and project accounts carried a deficit. For 4 of 24, or 17% of completed projects tested, the expenditures exceeded the budget and project funding. For example, one project's expenditures were $32 million, which exceeded the available funding and budget by $6.6 million. In addition, we observed the accounts for these projects had deficit balances from 1.5 to 3.5 years after payment of the final construction contract amounts. Pages 15 and 16 contain 4 recommendations to improve compliance with state laws and sound budgeting practices regarding capital construction, financing, and management. Beginning on page 17 and continuing on page 18, we discuss institutions needing stronger oversight of capital construction project management to improve the accountability of contractors and project managers. We observed change order documentation at both institutions was often not sufficient to determine compliance with contract terms and to ensure proper amounts were paid. We tested 49 change orders worth $8.3 million from 27 capital projects for almost $3.1 million, or 37% of supporting documentation that did not include detailed labor, material, equipment, or overhead and profit markup fee amounts. In addition, 12 of 49, or 25% of change orders tested lacked detailed supporting documentation for 70% or more of the project amount billed. Exhibit 5 on page 18 shows the unsupported change order number and amounts for projects tested at UNLV and UNR. For change order items with adequate documentation, we observed 38 of 49, or 78% of change orders tested had unallowed cost or incorrect markup fees. This resulted in over $200,000 in inappropriate payments to contractors. On page 19, we give some examples of unallowed change order costs. For example, a general contractor charged $14,000 for supervision and project administration on top of a $6,000 overhead and profit markup fee, despite supervision and project management being included in the 10% markup fee per the contract. On pages 22 to 24, we discuss how scope modifications through change orders increased project costs by $5.5 million and resulted in additional overhead and markup fees of more than $800,000. At UNLV, we tested $3.7 million in change orders and found $2.5 million, 69%, were the result of scope modifications that were not due to unforeseen circumstances. Unforeseen circumstances are issues that were not known when planning the project, like hazardous materials found on the construction site. UNLV, for example, spent $441,000 to upgrade paint for a parking garage after a department requested it, despite the original project scope including high-performance paint. At UNR, we tested $5.7 million in change orders and observed scope modifications increased project costs by $3 million, or 53%. Scope modifications also include additional costs as overhead and profit fees of 10 to 15% are added to the non-competitive pricing and also compound as each subcontractor charges their markup fee and the general contractor adds their fee for the overall change order cost. Pages 25 to 27 discusses the need for institutions to improve their project closeout process to ensure compliance with state law, guaranteed appropriate documentation is collected prior to final payment, and safeguard project funding. For example, the Labor Commissioner was not always notified of project completion, and 8 of 22, or 36% of projects, were not reported to the Labor Commissioner until after final contractor payment was made. NRS 338.013 requires the public body to report the completion of all work performed under the contract to the Labor Commissioner before the final payment is made. In addition, critical project documentation either was never obtained, issued, or received in a timely manner. Specifically, required project closeout documentation was never obtained for 11 of 22, or 50% of completed projects tested, and for 19 of 22, 86% of projects, final payment was issued before receiving documentation. When institutions do not comply with law relating to timely notification to the Labor Commissioner, there is a risk that prevailing wage laws will not be properly enforced. Workers might experience difficulty recovering wages. Additionally, when contractors are paid before important project closeout is received, institutions are at a higher risk of not receiving these critical documents or not being able to enforce critical contract provisions like liquidated damages and warranties. Pages 27 and 28 contain 9 recommendations to help control change orders and strengthen project closeout practices. Starting on page 29 and continuing on page 30, we discuss the need for NSHE to enhance its policies and procedures relating to procuring construction projects, as non-traditional procurement methods were utilized in the form of a public-private partnership and lease purchase agreements. Under a public-private partnership, the institution does not have a contract with the general contractor and loses some control over the management of the project, including accountability for the use of state-appropriated funds and the right to modify the project as needed. In addition, it is unclear under state law whether institutions have authority to use this method when procuring capital construction projects. Likewise, under the lease purchase agreement method, a developer was allowed to select the general contractor, manage project construction, and collect construction payments, leaving the institution with limited authority over project construction and oversight. Furthermore, during the 2005 legislative session, Senate Bill 426 created an advisory group to conduct an interim study concerning lease purchase agreements by public entities. Based on the findings, NSHE required institutions to adopt specific procedural language for these agreements on or before December 31st, 2007. However, both institutions failed to comply with this mandate, and NSHE did not enforce this policy. On page 31, we discuss state funding being appropriated for UNLV's medical education building under a public-private partnership. Specifically, $25 million was requested for furnishings and equipment, despite the development agreement stating the furniture and equipment was the responsibility of the nonprofit. In addition, when UNLV requested the funds to be transferred to the nonprofit, they did so without supporting documentation to ensure funds were spent in accordance with legislative intent. While the nonprofit indicated that final project expenses would be about $125 million, total funding for the project, including the $25 million state appropriation, was $143.7 million. The nonprofit indicated excess funding will be used for additional projects at UNLV. Legislative committee meetings regarding the appropriation indicated the funding should be the last dollar spent, and the bill included a reversion clause for unspent funds. However, based on the general language in Senate Bill 434 and the contract between UNLV and the nonprofit, it is unclear if any of the $25 million appropriation should be reverted to the state. On page 32, we note noncompliance with project solicitation, including 4 of 6, or 67% of CMAR projects did not advertise weights for evaluation criteria as required per NRS 338.1692. Institutional personnel stated they were unaware of this statutory requirement. In addition, 1 of 20, or 5% of design solicitations was missing an executed agreement and instead utilized the solicitation itself as the agreement. Lastly, the cost for a project solicited through the design-build method increased the construction contract by $1.8 million, or almost 10%, to the total construction cost when the 120-day project solicitation deadline was delayed 5 months. The review committee had taken almost 3 months to evaluate bid proposals, and another 2 months lapsed before institution's legal counsel completed the review of the contract. Page 33 contains 5 recommendations to strengthen procurement practices at NSHE, including seeking clarification on public-private partnerships and developing and revising policies and procedures related to project solicitations. Appendix A on page 34 shows Assembly Bill 416, Chapter 467 from the 2021 legislative session that requires the legislative auditor conduct an audit of the Nevada system of higher education. Appendix B on page 36 illustrates project funding sources at both institutions, and on page 37, Appendix C shows project construction costs due to change orders at each institution. Appendix D on pages 38 and 39 show project unsupported and unallowed change order amounts at both institutions. Appendix E on page 40 demonstrates project increases due to scope modifications at UNLV and UNR. On page 41 through 45, we describe our audit methodology. NSHE's response to the audit report begins on page 46. Then on page 48, we list the audit recommendations and show the system accepted all 18 recommendations. This concludes the audit presentation. I'd be happy to answer any questions.
Thank you very much for that information. Any questions from the committee? Thank you very much. I don't see any questions from the committee. I will take a motion for the audit report. So moved by Assemblywoman Miller, second from Senator Hammond. Any discussion on the motion? All those in favor say aye.
Aye.
All those opposed? Motion passes, and thank you very much again for all this hard work. All right, we will move to 4C, Nevada System of Higher Education Institution Foundations, and we'll have Mr. Forgas and Ms. Otto present. And did I say your name right, sir?
Yeah, Forgas for the record.
Thank you.
Vice Chair and Subcommittee members, my name is Zach Forgas, Deputy Legislative Auditor, and we will be presenting the Institution Foundations Report. Beginning on page 1 and continuing through page 6, we provide background information on the Nevada System of Higher Education, including institution foundations and associated foundations, private donations, and administrative fees. Exhibits 2 through 5 also provide general information on the financial growth of foundations, cash, investments, and other assets, and the availability of foundation assets. On page 6, we state our audit scope and objective. The objective of this audit was to determine if privately donated money was appropriately recorded and spent in accordance with donors' intended purposes. The audit findings begin on page 8, where we found that almost all gift donations were assigned to the appropriate foundation gift account in accordance with donors' intent. Our testing found 763 out of 774, or 99%, of sample donations at 7 institutions were properly recorded by the foundations. The sample included $116 million in donations received between July 1st, 2017 and June 30th, 2021. On page 9, we found that adequate documentation associated with donations and accompanying donor wishes were generally retained to support transactions. However, for 65 out of 774, or 8% of sampled donations tested, acknowledgement letters and donation receipts were not available at 5 of the 7 foundations. It is possible these letters may have been sent to donors, but some of the foundations just did not retain a copy. Exhibit 6 on page 10 displays this information. For federal tax income purposes, donors should have donation acknowledgement letters or gift receipts as backup for their tax deductible donations. These letters and receipts also provide the donor reassurance their donation was appropriately allocated as they intended. NSHE Board of Regents policies indicate foundations are to send donors timely acknowledgement of donations. Policies at the foundation level did not consistently address the nature and timing or retention of these acknowledgements. On page 11, we found 7 out of 110, or 6% of samples tested at the College of Southern Nevada Foundation had errors between the donation information recorded in the CSN Foundation's donor management software and the CSN Foundation's financial software. These errors were not seen at other institutions' foundations. CSN Foundation staff provided a reconciliation of the data from the two systems and were able to match the total donation dollar amounts over the 4-year audit scope. However, we found discrepancies related to donor information between the two systems. For example, in one instance, the donor was entered as the bank name, and this led to the acknowledgement letter being sent to the bank for a $10,000 donation and not to the correct donor. Furthermore, CSN Foundation staff could not provide support of donor intent in 10 out of the 110, or 9% of samples, excuse me. Because we could not establish donor intent, we could not verify the donation was allocated to the correct gift fund. At the bottom of page 11 and continuing onto page 12, we found one instance at Great Basin Foundation where donated money was not applied to the correct gift fund in accordance with donor intent. A donation of $94,000 designated by the donor for a memorial scholarship endowment was assigned to an unrestricted GBC Foundation gift account. While this is an isolated instance, the error was significant considering the size of the donation. During the audit, GBC Foundation staff transferred the donation to the correct gift fund, which we verified occurred in October of 2022. Page 12 also contains 2 recommendations to ensure the foundations have adequate policies related to acknowledgement or receipts for donors, and to encourage institutions, foundations, boards to verify key control processes are occurring. This includes reconciliation of donor software to financial software and retention of supporting documentation establishing donors' intent. Chapter 2 begins on page 13. We found institutions generally expended donated funds consistently with donor intent. Our testing found 686 out of 690, or 99% of gift fund expenditures tested were appropriately spent. The sample included expenditures totaling $23 million spent between July 1st, 2017 and June 30th, 2021. On page 14, we found at 6 institutions that privately donated money went unutilized for multiple years. While some of these amounts may be saving funds for a future purpose, many did not have donation or expenditure activity for at least 5 years. Some institutions' gift funds would benefit from a routine review of state accounts to identify opportunities to repurpose funds to other actively utilized accounts consistent with donations intended or donors' intended purpose. Exhibit 7 on page 15 shows this information. Board of Regents policies require donor notification if the foundation plans to delay for any reason the use of the restricted gift for its intended purpose. On page 16, we note that while 99% of donor funds were used in accordance with donor intent, we did find some instances where this was not the case. Some expenditures did not have sufficient supporting documentation. These were not egregious deviations, but warranted the attention of the institutions. Examples include scholarship expenditures, where a small number of students at 4 different institutions did not meet scholarship criteria specified by the donor. We also found instances related to documentation of a purchase order or contract for the expenditure was not finalized prior to services occurring. On page 17, we found 4 instances where athletics seat premium donations for one sport were used to pay game guarantees for a different sport at UNR. Due to an IRS rule change in 2018, foundation staff reported that this type of donation is no longer accepted, and such funds are now donated to a general athletics gift fund. We also found a small number of transactions in our sample being processed without adequate supporting documentation. This related to meal expenditures that did not list the specific team members or coaching staff that the meal was used for its intended purpose. As a result of a UNR Foundation internal audit in February of 2020, UNR's Intercollegiate Athletics Department is now required to provide the purpose of the meals and names of individuals. We tested an additional sample of UNR ICA expenditures in fiscal year 2022 and found that all expenditures had sufficient supporting documentation. On page 18, we have one recommendation to develop a policy requiring institutions to routinely review inactive gift accounts and identify opportunities to repurpose those funds to actively utilize accounts when appropriate and allowable. Appendix A, beginning on page 19, shows Assembly Bill 416, Chapter 467 from the 2021 legislative session that requires the legislative auditor to conduct an audit of the Nevada system of higher education. Appendix B, on pages 21 through 26, we describe our audit methodology. Appendix C on pages 27 and 28 contain NCHI's response to the audit report. Page 29 lists the audit recommendations and shows that NCHI accepted all of them. This concludes my presentation. I will be happy to answer any questions you might have.
Thank you very much for the presentation. Any questions from the committee?
Madam Vice Chair?
Assemblywoman Dickman, please go ahead.
Not a question, but just a comment. Really appreciate how detailed you went in this audit and still didn't really find much wrong. So it was kind of refreshing to see a positive outcome in one of your audits. So thank you for the hard work.
Thank you.
Thank you very much. Any questions? Okay, seeing none, I'll take a motion to approve the audit.
So moved.
So moved from Assemblywoman Miller, second from Assemblywoman Dickman. All those in favor say aye.
Aye.
All those opposed? Motion passes. Thank you very much. The next item, 4D, is Department of Employment Training and Rehabilitation. And we will welcome Ms. Barlow and Ms. Getz to the table. Please go ahead when you're ready.
Good morning, Chair Dondero Loop and members of the Vice Chair Dondero Loop and members of the Audit Subcommittee. For the record, my name is Amanda Barlow, Deputy Legislative Auditor. I will start with some background information which begins on page 1. The division's mission is to provide barrier-free communities in which individuals with disabilities have access to opportunities for competitive, integrative employment and self-sufficiency. As stated on page 2, the division has 7 budget accounts totaling nearly $39.7 million in expenditures in fiscal year 2022. Exhibit 1 on page 2 shows the division's revenues and expenditures for its operating accounts in fiscal year 2022. On page 3, we share additional information about the vocational rehabilitation or VR programming. VR services help people with mental or physical disabilities obtain or maintain employment through training, counseling, and other support methods. The division also coordinates with school districts to provide pre-employment transition services or pre-ETS. This includes job exploration, counseling, work-based learning experiences, higher education counseling, workplace readiness training, and self-advocacy. Exhibit 2 on page 5 shows the sources for grant funding for fiscal year 2020 and 2021, including federal and non-federal funding sources. The scope of our audit included a review of division activities related to adult and youth services in fiscal year 2020 and 2021. We also reviewed prior year's documentation back to 2009 for specific cases. Our audit objectives were to 1, analyze whether the division is performing sufficient outreach for pre-employment transition services youth programming, and 2, determine if certain activities related to the approval and oversight of the adult vocational rehabilitation programs are adequately monitored and approved. Our findings begin on page 7. The division lacks the necessary processes to adequately implement pre-ETS. The division fell short of meeting youth spending requirements by an average of 5% since 2018. The grant requires the division to expend at least 15% of the grant on qualifying pre-ed services. To comply with grant requirements, the division would need to decrease spending on adult clients by an average of $5.4 million per year, or increase pre-ed spending by an average of $814,000 per year. Exhibit 3 on page 8 shows spending totals for adult VR and youth pre-ed services between fiscal years 2018 and 2021. As stated on page 8, we found that the division has not adequately developed a service plan for pre-ed program delivery to ensure services, program, and financial requirements are met. To meet federal grant spending and match requirements, the division should engage in a thorough program planning process. A tool such as a logic model would help staff with planning, implementation, management, and evaluation of activities. We demonstrate on page 9 that some rural school districts have limited, if any, services for youth, while others have more established programs. 3 rural counties did not receive any youth services in either fiscal year 2020 or 2021. The primary services offered in the remaining rural school districts was a virtual job shadow. Online education may not always be the most effective tool considering the population served. However, in some instances, the only option available in many rural counties is the online services. Federal guidelines for transition services indicate that ideally, services focus on both instruction and in-person job exploration experiences, such as an in-person job shadowing or internships. Exhibit 4 on page 11 and 12 demonstrates the type of services offered by county throughout the state. On the bottom of page 12, we state that the division can increase services through enhanced collaboration and communication. Staff at 7 school districts interviewed indicated that although communication recently improved, there are significant ongoing challenges. For example, staff did not always respond to meeting requests or attend scheduled meetings. One school district was not aware of in-classroom opportunities, and several districts indicated they learned about services through discussions with other school districts. Additionally, school districts were told that certain services were not available to rural school districts. Most school districts contacted indicated a desire to increase collaboration with the division. The successful delivery of pre-eds relies on both entities being cooperative partners. On page 13, we indicate that the division did not adequately track program data. For example, invoices submitted by school districts totaling approximately $104,000 in fiscal year 2021. Comparable reports in the division's data management system totaled less than $37,000. Additionally, internal reports demonstrating participant totals did not match participant rosters. Without controls over data tracking, the division is not able to provide accurate reports in compliance with federal grant requirements, and management is ill-equipped to make decisions to direct programming. On page 14, we list 3 recommendations to improve program planning, communication, and enhance oversight of services to youth with disabilities. On page 15, we begin our findings regarding controls for the adult vocational rehabilitation services. The division lacks sufficient controls to ensure counselors perform annual reviews. 41% of client cases tested did not contain documentation that the client's employment plan was reviewed or updated annually. Without annual reviews of the employment plans, clients may not have the resources necessary to make progress towards achieving employment goals. On page 16, we indicate that counselors approved spending outside authorized limits. 9 of the 16 cases reviewed exceeded planned spending amounts, and cases reviewed did not obtain the required supervisory approval. These 9 cases totaled $104,000 in additional spending over the level of supervisory approved amount. With some plans reviewed, the original plan costs did not require supervisory approval, but the final cost exceeded approved amounts. The division does not have a process to ensure that costs remain within authorized spending amounts. On page 17, we state that division practices allow for the potential misuse of services. 15 elderly clients obtained hearing aids from the division, while only 3 clients provided evidence of employment. Many clients closed their cases without employment as an outcome after receiving hearing aids. Additionally, the division does not monitor vendors to prevent them from over-referring clients to the division solely to receive services not covered by other means. For example, 33% of the money spent on hearing aids in our testing sample came from one provider in Washoe County, which is disproportionate for the state. Although the division appropriately serves elderly clients, stronger controls can ensure that clients and vendors use division services to attain and retain employment. At the bottom of page 17, we indicate that additional efforts are required to improve the equitability of services. Fewer Asian and Hispanic or Latino individuals obtain services when compared to the Nevada population. Additionally, the average cost per client is more than $700 less than the average for Asian clients and about $500 less for Black or African American clients. The division recently began outreach for Hispanic or Latino individuals. However, the division's efforts do not address all inequities noted. On page 18, we list 5 recommendations to enhance managerial oversight of the adult programming for vocational rehabilitation. Appendix A on page 19 provides details regarding the program's location and descriptions of pre-employment transition services. Appendix B on page 20 is our audit methodology, and the division's response begins on page 25. The division accepted all 8 of our audit recommendations. This concludes my presentation, and I'd be happy to answer any additional questions.
Thank you very much. Any additional, any questions from the committee?
Yes, I have a.
Please, Senator Hammond.
Thank you, Madam Vice Chair. Actually, for the department, DETR, if they're in the audience, I think they're up in Carson City. I'm more concerned about the PRIET's information that was given to us, and was wondering, having received some of this information now, what your plans are to try and spend the money that is in those funds.
Please go ahead.
Good morning. My name is Drosnin Ellis. I'm the administrator of the Rehabilitation Division with DETR. Vice Chair Dondero Loop to Mr. Senator Hammond. So we, in the past year, we've kind of, I guess let me start off to say that one of the challenges that we had in spending PRIET's funds is in building out the vendor pool that exists in the state to be able to serve these students. The PRIET's funds were provided, or they were passed through the VO Act in 2014. So that was the initial notice that we had in having these additional funds, or not additional funds, but percentage of our funds that need to be allocated to serving this particular population. And over the past few years, we've been trying to build out that pool and create relationships with the various school districts to be able to serve the students. One of the struggles that we had is during the COVID, as a lot of the students started kind of receiving education from home, that kind of impacted some of the spending that we had, as we were not able to appropriately reach them in a safe manner. So as the pandemic has kind of waned down, we've started continuing to improve our relationship with various school districts throughout the state. We've set up these PACE labs at various school districts that provide in-classroom training on various types of vocational training, such as training on how to be an electrician, or not necessarily training, more exploratory training on how to be an electrician or a plumber or accountant or marketing jobs and such like that. So we've started putting these PACE labs in various rural districts, as well as we have a number of them in the Washoe County. And also we are working currently with the Clark County School District to expand that in there as well. And also we are, as I mentioned, working with the various kind of vendors in the state for them to expand the type of work that they do to be able to help us serve some of these clients and provide in-classroom training as well.
Thank you. And so if I understand you correctly, it was basically building out the vendor list, building out the vendor relationships, and then having more of a relationship with the school districts, find out what programs they have, and then adding to those programs as well. But you feel like those vendor relationships are in a position where you are able to now spend a little bit more money, develop programs where they're not, and expand programs where they do exist. So you guys are in a position to do that right now. This is
Drosnin Ellis for the record, Mr. Senator Hammond. Yes, we are in a position definitely to start spending more funds in this year. We're definitely going to spend more than we have in the previous years. We also, what I didn't mention, have in the last year restructured our PREATS agency to kind of elevate it within the department, so that way they have a more of a support from upper management as well, so that they're able to kind of create a better relationship with the school districts as well. So we definitely feel that we are in a much better position now to keep spending more of those funds and hopefully in the near future spend all of it. That's allowable.
Thank you, sir. Thank you, Madam Vice Chair.
Thank you very much. Any additional comments you'd like to make, sir?
This is Roslyn. I don't have any additional comments.
Thank you very much. Any additional questions, Assemblywoman Dickman?
Thank you so much, Madam Vice Chair. I just have a quick question about the fact that some of the minority populations are underrepresented. And I understand that could possibly be due to outreach issues. But I just wondered why the average cost per client is less for Asian clients or African American or Black clients.
This is Charles Nilitz for the record, Assemblywoman Dickman. I think part of the reason that we have some of the discrepancies in population is that as we look at the state of Nevada as a whole, and there's the entire population, part of that is we don't feel that that using that as a barometer as to how we are serving percentage-wise within the particular population that we are serving, that doesn't necessarily translate equally. So we would have to look at out of all of the population with disabilities, how does that kind of compare to what we have internally? But to your specific question around the cost, I think part of that comes down to just a smaller number of individuals that we are serving. Also, we need to also do a better job in communicating what all services are available to every population in their particular languages, if that is part of the barrier, and to ensure that they receive the full scope of services that's available. But I don't know that I have a very specific question on that. I would have to do some research and get back to you on that.
Thank you so much.
Thank you very much. Any other questions? Okay, seeing none, I'll take a motion to approve the audit. Moved by Assemblywoman Miller, second by Senator Hammond. Any discussion? All those in favor say aye.
Aye.
Any opposed? Motion passes. Thank you very much. All right, we will move on to item 4E. And this is the Department of Health and Human Services, Division of Health Care, financing policy, dual enrollments, and supplemental drug rebates. And we'll welcome Mr. Evenden and Mr. Peterson to the table. And please go ahead and make your presentation.
Vice Chair and committee members, for the record, I'm Will Evenden, Deputy Legislative Auditor. Beginning on page 1 and continuing through page 4 in the audit report, we provide background information on a Division of Healthcare Financing and Policy, including the division's mission, budgeting, staffing, revenues, and expenditures for fiscal year 2021, as shown in Exhibit 1 on page 2. In addition, the report includes information on different Medicaid programs, such as managed care organizations, abbreviated as MCOs, an overview of the supplemental drug rebate program, the federal Medicaid assistance percentage, and the public assistance reporting information system known as PARIS. The PARIS Interstate Match is a free data matching service for states overseen by the federal government that helps ensure the integrity of public assistance programs through detecting, entering, and proper payments by matching recipients of public assistance to other states to identify if recipients are receiving duplicate benefits in 2 or more states. The PARIS Interstate Match is performed quarterly in February, May, August, and November of each year. Nevada's participation in submitting program enrollment data for PARIS matching is required by the Social Security Act as a condition of receiving Medicaid funding for automated data systems. This act also requires the states to have an eligibility determination system that provides for data matching through PARIS or any successor system, including matching with medical assistance programs operated by other states. On page 5 in the report, we state our audit objective and scope. The objective of this audit was to determine if the Division of Healthcare Financing and Policy adequately monitored certain activities related to managed care organizations, enrolled participants, and drug rebate payments. The audit findings began on page 6, where we discussed that the division does not utilize available information to identify recipients who concurrently enrolled in Medicaid in another state. Using the Paris Interstate Match data, we identified 7,092 Nevada Medicaid recipients who are actively enrolled in an MCO, but also had concurrent enrollment in another state's Medicaid program. For 44 out of the 50 recipients tested that were enrolled in Nevada First, monthly capitation payments continued an average of 12 months after the individual enrolled in another state. Using statistical principles, we estimated improper payments for calendar year 2020 were $13 million and $9.9 million for calendar year 2021. In the report, we acknowledged during the public health emergency there were restrictions on Medicaid disenrollment. However, as stated on page 7, per federal public health emergency guidelines, during the public health emergency, the division was still allowed to disenroll individuals from Medicaid if the person was found to be no longer a state resident. Exhibit 3 on page 9 in the report shows examples of 5 Nevada Medicaid recipients who had concurrent enrollments in other states, their length of concurrent enrollment, and total improper capitation payments in calendar year 2020. Continuing on page 9, we discussed that federal law and state policy do not allow a Medicaid recipient to be enrolled concurrently with another state Medicaid program. To qualify for Medicaid, you need to be a resident of the state you apply for Medicaid. So once a Medicaid recipient enrolls in another state's program, they no longer qualify as a Nevada resident for eligibility purposes. We also acknowledge on page 9 that using the PARIS data alone cannot solely be used to determine a recipient's eligibility and terminate coverage. The agency must seek additional information from the recipient. However, per federal law, once a state confirms the recipient has been determined to be enrolled in another state's Medicaid program, the state is not required to provide advance notice of termination. In addition, on page 9, we note other states we reviewed have documented processes for performing analysis of the PARIS data. For example, although not mentioned in the report, we observed the state of New York has detailed processes for following up on PARIS data interstate matches and disenrolling ineligible participants and recovering improper capitation payments retroactively for the months where medical claims for recipients were not paid. Continuing the bottom of page 9 and top of page 10 in the report, we discuss in the report that the division does not have a process or policies or procedures to identify and recover improper capitation payments for dual enrollments. However, contracts between the division and MCOs allow the division to adjust or recover improper capitation payments for up to 3 years. As defined by the contracts, improper payments include fraud, waste, abuse, and errors on the part of the division. Moving on to the supplemental drug rebate program of the report, which starts on page 10. We discuss that the division does not actively monitor or perform required audits of its supplemental drug rebate program to ensure the timely collection and accurate payment of drug rebates by MCOs as required by Senate Bill 378 of the 2019 legislative session, which went into effect on January 1st, 2020. On March 27, 2019, the division issued a memorandum to MCOs detailing the requirement to submit rebates, less a 1% administration fee at the end of each quarter. Furthermore, the division indicated MCOs were to provide a comprehensive reconciliation of pharmacy rebates invoiced and received with each payment. However, despite issuing the memorandum, we found the division took no additional action to verify millions of dollars in supplemental drug rebates. As a result, one MCO failed to pay the division collected rebates for almost 2 years, which resulted in a lump sum payment of over $6.9 million. That was paid only after we performed an analysis and inquired about the unpaid rebates. Neither the division nor the MCO could explain why the payment was not remitted. Despite this payment and those made by other MCOs, records show another $4.2 million in rebates were invoiced to drug manufacturers by the MCOs and were not remitted to the state. Continuing on page 11, the report discusses the division did not obtain supporting documentation to ensure supplemental drug rebate payments were made accurately or timely. In addition, the division did not establish formal policies and procedures to reconcile or review documentation of supplemental drug rebates, invoice collected, received by MCOs. During the audit, we found the division did not have supporting documentation from the MCOs to determine what supplemental drug rebates were owed. We requested directly from the MCOs the supporting documentation for supplemental drug rebates, in which we identified another $900,000 in drug rebates were collected by the MCOs from drug manufacturers but not remitted to the state. Furthermore, we found $3.3 million in rebates was invoiced to drug manufacturers by the MCOs, but this remains outstanding as the MCOs indicated it has not been collected from the drug manufacturers, for a total of $4.2 million outstanding, as previously mentioned, in addition to the lump sum of $6.9 million paid to the division on November 30th, 2021. Starting on the bottom of page 11, we discussed that required audits of certain MCO activities related to supplemental drug rebates are not being performed as outlined in Senate Bill 378, which requires the division to perform an annual audit of each MCO, including analysis of all claims processed to evaluate supplemental drug rebate compliance. Continuing to page 12 in the report, we note that Senate Bill 378 also requires the division to obtain an annual audit of internal controls to ensure the integrity of financial transactions and claims processing, and that the results of these audits must be posted on the division's website. Effective January 1st, 2022, the division amended its MCO contracts to include provisions that help ensure compliance with statutes by requiring annual audits by the division and by the independent accountant, and give the state or its designee the right to review and audit information related to supplemental drug rebates, and provide for mutual cooperation and grant auditors full access to relevant information. According to the division, staff turnover impacted the division's ability to perform and obtain audits specified in Senate Bill 378. On pages 12 and 13 of the report contains 10 recommendations to reduce improper MCO capitation payments and improve the collection of MCO supplemental drug rebates. Appendix A, starting on page 14 in the report, shows MCO composite estimates for capitation rates by region, category, and age group for calendar years 2020 and 2021. Appendix B on pages 16 through 19 describes our audit methodology, and Appendix C on page 20 to 23 shows the division's response to our audit. And on page 24, we list the audit recommendations and show that the division accepted it all 10 recommendations. This concludes my audit presentation. I'd be happy to answer any questions.
Thank you very much. Any questions from the committee? Assemblywoman Dickman, did you have a question?
I actually was scratching an itch, but now that you asked me, thank you. This is actually not for the auditors, though. It's for the department.
Thank you. They're coming forward.
Thank you.
Go ahead with your question.
Sorry, I was muted. Wondering why it would require an audit and auditor recommendations, for example, to force compliance with SB 378 when it was passed in, 2019? I mean, shouldn't that just be happening without an audit?
Madam Chair, if I may start the response. This is Marla McDade-Williams, Deputy Director, Department of Health and Human Services. Before I have Ms. Roybal respond, I just want to take an opportunity to thank the LCB auditors for this audit and acknowledge that we've had changes in leadership at the Division of Healthcare Financing and Policy, and we've had multiple vacancies in the division throughout the pandemic. The department is committed to assisting the division in putting the systems in place to prevent these findings in the future and to make needed improvements. Additionally, we're looking forward to the efforts of the Department of Administration on developing solutions to position vacancies and challenges with retention of staff. And as you know, audits come in and they assess how we're managing programs, and there's never an intent not to implement programs as well as we can, particularly with Medicaid. I think there's always a focus on ensuring that we are doing everything we can to provide proper services while ensuring that we're managing as responsibly as we can fiscally. If there's a specific question, I'm happy to turn it over to Sandy, but there's never an intent not to implement programs as well as we can. It just happens. And we do our best to ensure that we have policies and procedures in place and that we have the staff to actually comply. And I think staffing challenges have been very real for the Division of Healthcare Financing and Policy. And we are right now still down some very key positions that would provide oversight to the staff managing the programs. And we are doing the best that we can to get those positions filled and get things on track as much as possible.
Thank you. And Madam Chair, if I may, I do appreciate the shortage in positions and so on. But as far as not using the Paris system and, the like $23 million perhaps, I guess my specific question is can these overpayments be recovered?
Good morning. Thank you for the question. Sandy Rublid for the record. I'm a Deputy Administrator at the Division of Healthcare Financing and Policy. We, again, thank the auditors for these findings. It does help us improve our program, which is very important to us. We are currently discussing how we would go about recovering any improper payments with both our federal partners and we heard this morning about other states that are doing this. We will also be speaking to those other states and look forward to providing that detail in our corrective action plan.
Thank you. Appreciate that. Thank you, Madam Vice Chair.
Thank you very much. And I would just like to take a personal moment and express my condolences, and I'm sure of the committee, over the passing of Ms. Melissa Lewis, who was your Chief of Fiscal Operations. And so I know that will also leave a hole in your team. But please know and please relay to your colleagues that we are all thinking of you. Thank you.
Thank you very much.
So with that, thank you. So with that, I will take a motion to approve this audit. So moved by Assemblywoman Miller, seconded by Senator Hammond. Any discussion? All those in favor, say aye.
Aye.
All those opposed? Motion passes, and we will move on to 5. Yay, we left 4. We went to 5. Agenda item 5, the presentation of governmental and private facilities for children. Mr. Crossman, please go ahead.
Thank you, Vice Chair. For the record, Dan Crossman, Legislative Auditor. One of the roles that we have is to review governmental and private facilities for children on an ongoing basis and provide information to assist in legislative oversight. Ultimately, our goal is to help ensure adequate protection of the children that are in these facilities. Our efforts in this area have been to continue to increase the number of facilities that we can visit and inspect. This year, our report contains 19 facilities that we performed inspections of. And with that, with your permission, Vice Chair, I would turn the time over to Haley Cornelia, our Child Welfare Specialist, to present the report.
Please go ahead when you're ready.
Good morning, Vice Chair and members of the subcommittee. For the record, my name is Haley Cornelia, Child Welfare Specialist. I am here to present our governmental and private facilities for children inspections report for 2022. Our work was conducted pursuant to NRS 218G.570 through 218G.595, which requires us to determine if Nevada facilities adequately protect the health, safety, and welfare of the children in the facilities, and whether the facilities respect the civil and other rights of the children in their care. On pages 1 through 3, we discuss background information and the type of work we completed. As of June 30th, 2022, we had identified 57 governmental and private facilities that met the requirements of NRS 218G. We completed inspections of 19 of these facilities during this year. Beginning on page 3, we discuss our inspections of 5 children's facilities where we identified multiple issues that caused us to question whether each facility adequately protected the children in its care. Continuing to pages 4 through 8, we discuss Nevada Homes for Youth. Nevada Homes for Youth is considered a facility for the treatment of abuse of alcohol or drugs and is licensed by the Bureau of Healthcare Quality and Compliance, commonly referred to as HCQC, and contracted as a placement resource by Clark County Department of Family Services, or DFS. At the time of our inspection, they had a certification to provide substance abuse services by the Substance Abuse Prevention and Treatment Agency, or SAPTA. This was our 3rd visit to the facility in the last 5 years. Some of the significant issues noted at Nevada Homes for Youth included incomplete and inaccurate medication records, children self-administering medication, and missing medication. In addition, we observed contraband and noted issues with child intoxication, missing statutorily required personnel records and training records, unsanitary living conditions, inappropriate age-related activities, incomplete and altered child records, and weak policies and procedures. Following our inspection in June 2022, we communicated our concerns to HCQC, SAPTA, and DFS. HCQC and SAPTA noted similar concerns in subsequent follow-up visits, which HCQC reported resolved in additional follow-up visits. On page 8 of the report, we state that Nevada Homes for Youth has a provisional SAPTA certification, has maintained licensure through HCQC, and continues to accept placements from DFS. As an update to our report, we were notified last week that the facility failed to renew their SAPTA certification after being placed on corrective action, which is a licensure requirement for this type of facility. SAPTA certification was withdrawn from the facility as of December 1st, 2022. As stated on page 8 of our report, we recommend that the licensing agencies and placement agency enhance communication and coordinate their efforts to ensure proper oversight of the facility. Beginning at the bottom of page 8 through page 11, we discuss concerns noted at Never Give Up Youth Healing Center, commonly referred to as NGU. NGU is a psychiatric residential treatment facility licensed by HCQC. This was our 2nd visit to NGU in the last 5 years. Some of the significant issues noted included incomplete and missing medication records, administration of medication without statutorily required consent, and staff were unaware of children's treatment plans. Additionally, damaged property posed safety hazards, there were missing statutory required personnel records and training, and documentation was missing that an incident was reported in accordance with mandated reporting requirements. We also noted unsanitary living conditions, including a blood-stained pillow, clogged toilets and urinals, and piles of clothing. Beds were missing pillowcases, sheets, and bed coverings, and inappropriate age-related activities were observed. Lastly, policies and procedures were weak. Following our inspections in August 2022, we communicated our concerns to HCQC. HCQC completed 3 complaint investigations prior to our visit and completed 2 additional complaint investigations after our visit, noting similar concerns. HCQC also imposed a financial sanction on the facility. Continuing to pages 12 through 14, we discuss Three Angels Care. Three Angels Care is a foster care agency licensed by Washoe County Human Services Agency. We visited 4 homes operated by Three Angels Care and noted concern at 3 of those homes. Issues included incomplete and missing medication records and a missed medication administration for a child. An outside locking storage room in one home was being used as a place to sleep and as a quiet room that children voluntarily spent time in. Additionally, children of opposite gender were sharing a room. There was lack of supervision and weak policies and procedures. Washoe County implemented corrective action plans for 2 of the homes and issued an additional corrective action plan for the director of Three Angels Care. All corrective action plans have since been resolved according to Washoe County. On pages 14 through 17, we note our concerns with 2 homes licensed through the Advanced Foster Care Program at the Division of Child and Family Services, or DCFS. Issues included unsecured tools, chemicals, and knives. There was not a secure method for medication storage, incomplete training records, missing documentation to support a repeat background check for a foster parent, and weak policies and procedures. Additionally, complaint forms were not readily available, the complaint process was not posted, and there was no documentation that children were made aware of their right to file a complaint. In turn, a serious complaint on behalf of a child was not forwarded to the legislative auditor. After our inspections in July 2022, DCFS did not renew one of the foster parents' licenses. DCFS previously did not classify their advanced foster care homes as foster care homes that provide specialized care. After discussion with their legal counsel, they were advised that their homes are considered foster homes that provide specialized care under statute. DCFS is in the process of updating its policies and procedures. On pages 17 and 18, we noted a concern for implementation of federal standards established by the Prison Rape Elimination Act, commonly referred to as PREA, at 2 of the 8 correction and detention facilities that we inspected. PREA standards require juvenile correction and detention facilities to use a screening tool to assess children for sexual victimization or abusiveness. We determined 2 facilities used a screening tool which did not assess for 10 of the 11 items required by screening standards. The PREA coordinator for the state agreed the facilities did not use a screening tool that met federal standards. The state has developed a screening tool for facilities to use. As stated on page 18 of our report, we recommend that the facilities obtain and implement the assessment tool developed by the state or create their own assessment tool which meets PREA requirements. In addition to facility inspections, we review complaints forwarded to our office from facilities. This information is located on pages 19 through 21. NRS 218G requires facilities to forward to the legislative auditor copies of any complaint filed by a child under their custody or by any other person on behalf of such a child concerning the health, safety, welfare, and civil and other rights of the child. We received 636 complaints from 30 facilities in Nevada in fiscal year 2022. The other 27 Nevada facilities reported that no complaints were filed during this time. Based on our review of complaints, we have identified that collection, documentation, review, and resolution of complaints vary at each facility. Facilities also have different interpretations of what constitutes health, safety, welfare, and civil and other rights of a child. Exhibit 4 on page 21 summarizes complaints received in fiscal year 2022 submitted by facilities based on the type of facility. During our inspections, we found 2 complaints that were not forwarded to the legislative auditor. One complaint alleged neglect of a child at a facility, and another complaint described physical discipline of a child at a facility. Appendix A on page 22 contains a glossary of terms used in the report relevant to child welfare. Appendix B on page 26 contains a list of inspections we completed. Appendix C on pages 27 through 29 provides some background, population, and staffing information on the 57 children's facilities in Nevada. Appendix D, beginning on page 30, is our methodology. That concludes my presentation. I would be happy to answer any questions the subcommittee may have.
Thank you very much. I don't even know how to process this. Any questions from the committee? Assemblywoman Dickman? This is not a question, it's just a comment. Honestly, as I was listening to you, all I could think of is if I was a parent, I would be furious because your child is in the care, and it seems to me you shouldn't have to complain to have things right. They should just be right. So I hope moving forward, we're taking care of those vulnerable children. And I recognize the difficulty in this type of work. I just don't even know what to say when I hear some of these complaints. So I appreciate your time in presenting this report. And with that, I would hope that we don't hear another report with these same complaints in the future. With that,
Madam Vice
yes,
Chair,
go ahead.
Thank you for making that comment, because was this not the hardest report to read? Just a comment. I appreciate your comments, because it's awful. And I'm so glad we have these auditors that do check on it at least. Thanks.
Thank
for the
you.
indulgence.
Thank you. Okay, with that, I'll take a motion to accept the audit. Thank you, Assemblywoman Miller. Moves for the audit. Second from Senator Hammond. Any discussion from the committee? All those in favor say aye.
Aye.
All those opposed? Motion passes. Thank you very much for your time today. And with that, we will go to agenda item 6, presentation of State of Nevada single audit report. And Ms. Getz and Mr. Schlicker from Ide Bailey, I believe, please.
Good morning, Madam Vice Chair and members of the Audit Subcommittee. For the record, my name is Tammy Getz, Audit Supervisor. I will begin with a brief overview and background information on the single audit report for the year ended June 30th, 2021. The single audit was performed under a contract with the firm of Ide Bailey. The single audit is required by the federal government for state agencies who accept and expend federal funds. The statewide single audit incorporates audits of the financial statements and compliance with requirements related to federal funds. The audit of federal funds is an audit of certain programs and related requirements established by the federal government for use and management of those funds. The financial statements are comprised of the independent auditor's report, management's discussion and analysis, the financial statements, notes to the financial statements, required supplemental information and related notes, and the independent auditor's report on financial reporting. The independent auditor's report in the single audit report notes the financial statements received an unmodified opinion. This means the auditors have been able to access all financial information and that the information conformed to accounting principles generally accepted in the United States of America. Although a separate qualified opinion was indicated over the general and highway funds inventory as it relates to donated personal protective equipment and stockpile inventory. Management's discussion and analysis provides a narrative overview written by the state controller of the financial statements and highlights information for readers. The actual financial statements and notes to the financial statements provide further detail and information and should be read in conjunction with the financial statements. The auditor's report on federal compliance for each major program for the state had 46 findings related to federal compliance. The most significant findings are those considered material weakness with material noncompliance. A material weakness is identified as a deficiency in internal controls, which is significant and results in noncompliance with a requirement of a federal program, which will not be detected or corrected on a timely basis. There were 17 of these findings in this report. The auditor's report on federal compliance also noted that the schedule of expenditures of federal awards is accurately stated. The schedule of expenditures of federal awards identifies over $13.9 billion in federal awards was expended by the state in fiscal year 2021. In 2020, $11.1 billion, and in 2019, $5.8 billion was expended. The 17 findings related to the financial statement audit related to errors in recording unemployment, highway fund inventory, receivables and developer deposits, capital assets, and Medicaid and CHIP receivables, liabilities, expenses, and payables. Additional errors were found regarding cash and investment disclosures, outside bank account reconciliations, prescription rebates, internal balances, and the overall control environment and activities. Accounting adjustments were made to correct most errors. The remaining findings relate to federal awards. As previously stated, there were 46 federal compliance findings in fiscal year 2021, which is an increase from prior years. There were 25 in fiscal year 2020 and 33 findings in fiscal year 2019. There were 18 programs audited in fiscal year 2021. In addition, the single audit report contains management's response to auditor findings, including the prior audit findings and corrective action plans prepared by agencies who received the findings. As part of the audit process, Eide Bailly confirmed the status of these findings related to any programs audited in the current year. Furthermore, federal entities are supposed to issue management decisions regarding state agency corrective actions for any current year findings, essentially approving or denying the corrective action plans. That concludes my overview of the single audit report. I would like to express the Audit Division's appreciation for the professionalism of Eide Bailly in completing the single audit this year and in prior years. Representatives from Eide Bailly are present today to answer any questions the committee members may have. Thank you.
Thank you very much. And are there any questions from the committee? Assemblywoman Dickman?
No, thank you.
Okay. You're off the hook. Thank you. Do you have something you'd like to add, please? Go ahead.
Hi, yes, thank you. Kurt Schlicker, audit partner with Eide Bailly, for the record. I do just want to add quickly, we very much appreciate and want to thank LCB for their continued collaboration. They are fantastic to work with, great assistance. I would like to just maybe provide 2 minutes of brief comments to help supplement Audit Supervisor Tammy Getz's presentation. The audit took place from May of 2021 and wrapped all the way in July of 2022, so that's roughly a 14-month process. It's very complex, does take a long time. It did cover $13.9 billion in federal expenditures this year, the most significant of that being unemployment, lost wage assistance due to the pandemic, emergency rental assistance, and a lot of other COVID programs. The findings this year are a significant increase from the prior year, and I'm not going to belabor all the findings and go into into bad detail. However, I do want to highlight that we did write a finding over the overall control environment of the state, and the increase in findings that we've seen and the number of findings that we've seen, we've continually seen a lack of improvement in the reliability or the quality of data that is being prepared and presented to the Controller's Office, reviewed, compiled, whether from state agencies or from within the Controller's Office. And we've seen a continued decline in that reliability and quality of data, and that is what led to our overall control environment finding that we presented today. Most of the findings in detail for material noncompliance relate to reporting findings and subrecipient monitoring findings. And those reporting findings, again, speak towards reliability and accuracy of data. And I think at the root cause for the majority of these findings is due to reliability and accuracy of data. So again, I just want to thank LCB. I do want to thank the state agencies in the Controller's Office too, even though there's a lot of findings. They do work with us. They are cooperative. They don't withhold information from us. But, I'm speaking more towards the outcome as far as reliability, not the process. They are very professional. It's just there's a lot of errors. So with that, again, I'd be happy to answer any questions, but if you have none, then we'll move on.
Thank you very much, and we all, I'm sure, agree 100% with you about LCB and our agencies, so thank you. Any questions? Assemblywoman Dickman?
No,
Okay.
no, thank you.
Thank you, and we do appreciate your work with the agencies, and thank you for the complete report. All right, we will move on to agenda item 7. Mr. Crossman, please.
Thank you, Vice Chair. For the record, Dan Crossman, Legislative Auditor. I'll just briefly highlight what we're going to be talking about here for a few minutes. The 6-month reporting process was established in statute many years ago to help ensure that audit recommendations are implemented to the satisfaction of my office as well as this subcommittee. That process begins with a 60-day plan of corrective action, which is followed up 6 months after that with a report by the Governor's Finance Office through their Division of Internal Audits. And what we are presenting today is their report as well as a summary memo from our office based on our review of the status of implementation. We continue to work with agencies after we receive that initial 6-month report from the Division of Internal Audits to update our understanding and receive additional information until all are satisfied. So with that, we can begin with the presentations on the 6-month reports. Vice Chair.
Thank you very much, and thank you all for your patience as we work through this agenda. So we'll start with 7A, Department of Corrections, Use of Force. Mr. Lara?
Yes, good morning. For the record, my name is Eugene Alara, Audit Supervisor. In March 2022, we issued the report on the Department of Corrections. The 6-month report issued by the Office of Finance was received in December 2022 and indicated that 13 of our 16 recommendations were partially implemented and no action was taken on 3 recommendations. Subsequent to the completion of the Office of Finance report, the department submitted evidence to our office regarding progress made on 2 recommendations. This evidence related to recommendation number 11, requesting the department develop a policy and training for the use of the restraint chair, and recommendation 13, requesting the department develop a policy and training for proper coding of use of force data. After reviewing the evidence, we now consider recommendation 11 to be partially implemented. Due to the late submission of evidence and the need for additional documentation, we are not changing the status of recommendation 13 at this time. Therefore, as of the date of this meeting, the status of our 16 recommendations is 14 partially implemented and 2 with no action taken. These 16 recommendations are listed in your packet and relate to improving the department's processes regarding use of force monitoring, training, data collection, and other related activities. We have 2 questions related to our recommendations that we would like to direct to the department today. The first question is, why hasn't the department made significant progress towards full implementation? And the second question is, what is the department's timeline for full implementation?
Please go ahead when you're ready, and welcome back to Nevada, Director Zarenda.
Yeah, thank you, Vice Chair and members of the Legislative Audit Subcommittee. My name is James Zarenda. I'm the Director for the Nevada Department of Correction. Today is my day 4 with the agency. However, I did review the audit and the findings and the recommendations that were given to me yesterday. So as many of you do know, use of force is a high priority of my history here of trying to correct and make it better with training, with reduction of use of force, with utilizing other alternatives rather than use of force, especially when you deal with a lot of individuals that have been diagnosed with mental illness in the institutions across the state. My history also, as you know, with eliminating the shotguns use for use of force in the agency was not an easy task, but was a high priority of mine. And a continuation of trying to improve use of force is going to be one of my big goals over the next 4 years. But with resulting of the last 4 to 6 months on compliance to the recommendations, I'll leave that up to Deputy Director William Gitter.
Good morning. For the record, my name is Bill Gitter, Deputy Director of Operations for the Department, soon to be Warden of Ely State Prison again. Madam Vice Chair and committee members, first question, why haven't we made more progress? Well, over the past year, especially the 6 months of this report, the personnel shortages in the department have reached pretty much 1 in 3 officers. And that pushes our supervisory and management staff forward online to ensure the daily operations, the humane treatment of offenders is our primary responsibility, protection of the public. So in the midst of our personnel shortages, we have been working every day to maintain the security of the public and the humane treatment of the offenders, and not so much pushing the administrative ball forward with these initiatives. That's not an excuse. We certainly take it seriously, and it's lucky that Director Zarenda has come back to the department and new leadership has been established so that we can not only continue our daily efforts of maintaining public safety and the humane treatment for the offenders, but also pushing these initiatives forward so we can bring them all to fruition and make the department better. I'd like to take a moment to thank Mr. Crossman and his staff. They always do a phenomenal job. They make our department better, and the way they do it and their professionalism makes me want to work hard to be better for their department. So thank you, Mr. Crossman.
Thank you very much. Any questions from the committee? Assemblywoman Dickman, any questions from up north?
No, I thought I could
All
think
right.
of. Thank you.
Okay. I guess my suggestion would be that perhaps we might want to hear from you in the future about an update and where we're at that point on this subject.
James Zarenda for the record, absolutely, and it'd be a pleasure to.
Thank you. So with that, I'll take a motion to approve this 6-month report. Moved by Assemblywoman Miller, seconded by Senator Hammond. Any discussion? All those in favor say aye.
Aye.
All those opposed? Motion passes. And we will go to 7B, Department of Health and Human Services, Division of Child and Family Services, Management of Maltreatment Reports, and Child Health. Ms. Getz, please go ahead when you're ready.
Good morning again, Madam Vice Chair and members of the Audit Subcommittee. For the record, my name is Tammy Getz, Audit Supervisor. In March 2022, we issued an audit report on the Division of Child and Family Services, Management of Maltreatment Reports, and Child Health. The division filed its plan for corrective action in June 2022. NRS 218G.270 requires the Governor's Office of Finance to issue a report within 6 months after the plan for corrective action is due, outlining the implementation status of the audit recommendations. Enclosed in your binder is the 6-month report prepared by the Office of Finance on the status of the 11 recommendations contained in the audit report. As of December 2022, the Office of Finance indicated 9 recommendations were fully implemented and no action was taken on 2 recommendations, recommendations number 6 and number 10. Recommendation number 6 was to implement a process to identify and assess Medicaid claims that indicate possible abuse and neglect for children in state custody, and perform follow-up activities to ensure the welfare of children as necessary. The Office of Finance indicated the division plans to work with Medicaid, the Family Programs Office, and the Office of Analytics to identify ways to establish a link between Medicaid and Unity to identify possible abuse and neglect for children in state custody. The division asserted this recommendation is a high priority and will be implemented after recommendation number 10 is completed. Recommendation number 10 was to complete a feasibility assessment of linking the Medicaid claims database to Unity. The Office of Finance also indicated the division plans to identify ways to locate grant funding to establish a link between Medicaid and Unity. The division stated it will contract with a vendor to complete the project once funding is secured. While a link between these 2 systems would be useful, we found it not necessary in order to review medical claims for evidence of possible abuse and neglect. We obtained and reviewed claim data directly from Medicaid to complete our audit testing. Both state and federal entities have evidenced the child welfare benefits of utilizing Medicaid claims to identify potential incidents of child abuse and neglect. Therefore, we have the following questions for the division. Has the division identified a source to fund programming changes to create a link between Medicaid and Unity? And if not, does the division intend to obtain and review claim data of children in state custody to identify possible abuse and neglect?
Thank you very much for that. Do we have somebody here? Go ahead when you're ready up north.
For the record, I'm John Bradkey, Deputy Administrator, Child Welfare. And I first and foremost thank the audit team for this audit that truly helps us improve the care and treatment of children in our custody. In response to the question, ARPA funds have been approved for the purpose of purchasing a new Unity system that will include an interface between Medicaid and Unity. The first steps in this process are underway. The division is poised to release 2 RFPs related to this process. The first, an RFP associated with completing a needs assessment, and the second, an RFP for a contracted manager who will oversee the process from needs assessment to procurement and finally to implementation of a new system. We also wish to express our appreciation for the appropriation of ARPA funds to this purpose. This will greatly enhance our ability to oversee many processes in the division. That is my response.
Thank you very much. Any questions from the committee?
No, Madam Chair.
Okay, seeing none, thank you for that information. I'll take a motion to approve this report.
So moved.
Thank you, Assemblywoman Miller. Second from Senator Hammond. Any discussion? Hearing none, all those in favor say aye.
Aye.
All those opposed? Motion passes, and we will move on to 7C, Department of Health and Human Services, Division of Healthcare Financing and Policy, Information Security, and Ms. Idle Bingham. Are you, there you are. Please go ahead when you're ready.
Thank you. Good morning, Madam Vice Chair and members of the Audit Subcommittee. For the record, my name is Shirley Itel Bingham, Information Security Audit Supervisor. In March of 2022, we issued an audit report on the Division Healthcare Financing and Policy, Information Security of the Department of Health and Human Services. The division filed its plan for corrective action in June of 2022. The governor's NRS 2018G.270 requires that the Office of Finance, the Office of the Governor, to issue a report within 6 months after the plan of correction action is due, outlining the implementation status of the audit recommendations. Enclosed is the 6-month report prepared by the Office of Finance on the status of the 6 recommendations contained in the audit report. As of December 15th, 2022, the Office of Finance indicated all recommendations were fully implemented. Therefore, we have no questions for the agency officials. Thank you.
Thank you very much. And with that, we will ask for questions. Seeing none, I will take a motion to approve this 6-month report. Oh, Assemblywoman Dickman, go ahead, please. Do you have a question?
No, I just made the motion to approve.
Oh, okay. I'm sorry. I didn't hear what you said totally. Thank you very much. Assemblywoman Dickham made the motion to approve. A second? Second by Senator Hammond. Any discussion? All those in favor say aye.
Aye.
All those opposed? Hearing none, motion passes. Thank you very much, and thank you, Assemblywoman Dickman. So with that, we will go to agenda item 8, which is the second period and final period of public comment. We'll invite our in-person in Las Vegas and Carson City first, and then we'll do our virtual. So let's start with Las Vegas. Do we have anybody here that would like to make public comment? Do we have anybody in Carson City that would like to make public comment? Seeing none, BPS, when you're ready, we'll go to the phone lines.
Thank you, Vice Chair Don Luke. To provide public comment, please press star 9 on your phone now to take your place in the queue. Chair, the public line is open and working. However, there are no public commenters on the line at this time.
I appreciate that. Thank you very much. And with that, I would like to thank the audit department, Mr. Crossman, for all your hard work. I know that these are time consuming and they are done very well, and we are very happy that you are all with us to do these reports. So with that, I will adjourn the meeting, and thank you very much, all of you, for your time. Thank you, Assemblywoman Dickman up in Carson.
Thank you.
You're welcome. Thank you. Everybody have a nice day and see you soon.